Markets continue to see clarity around President Trump's tariffs against Canada, Mexico, and China. With us now is Joe Amato, President and Chief Investment Officer at Neuberger Berman, which has $508 billion in assets under management. Joe, good to see you.
Good to be here. Thanks, Mike.
Thanks for coming in.
Sure.
So let's talk about first, I guess, what your fundamental premise was for the economy and markets coming into this year, and how, if at all, does the whole trade policy flux influence all that?
Well, we came into the year thinking that growth in 2025 was going to be better than consensus, and some of the deregulatory issues that came out of this new administration, or were expected to come out, and the animal spirits that were being created was going to help growth. So our team thinks we were going to be 3 percentage points, tenths of percentage points higher than what the consensus was. Now, we did say we thought the first couple of quarters of the year were going to be tricky, because there was a new administration. You certainly had the tariffs issue hanging out, which came to light, of course, over the weekend. I think you've seen some volatility in the bond market late last year. The bond market sort of calmed down this year. So I think the administration is still getting its footing, but certainly the speed and scope of some of the things that they've initiated, tariffs being the latest example of it, it was a bit surprising.
And so surprising, I guess, maybe some people have a strong view as to whether a certain percentage of tariffs on some countries is this inflationary for this period of time, or it's this much of an impediment to growth. I think what you can say for sure is I've been talking about it being, it's kind of sand in the gears of trade and it's dust in the eyes of business leaders, right? It's kind of like an excuse to do less in terms of committing capital and business. So how does that play out? Are we making too much of it? Do we just want to get to some kind of stable equilibrium on, okay, I guess this is going to be what the rules are, and go from there?
Well, I think tariffs certainly have important implications. If these tariffs were imposed over the course of a full year, the expectation we would have is that growth would probably be maybe as much as a half a point lower than what our expectation was. We thought that inflation could be as much as a half or 3/4 of a point higher than what our expectation was for over the course of the year. Those are meaningful numbers, right? So it is something that, of course, we have to pay attention to. Now, how much of it's a negotiating point? I think the weekend yesterday gave you some sense for that. That was our expectation, but you never know, right? China comes in overnight and retaliates, and you've got another few months that there's going to be a review on China tariffs, so there's probably another bite at the apple when it comes to China.
Joe, take me to 29 days from now, the night before the 30 days expires. Client calls you up, says, Joe, tariffs tomorrow or something. What do you tell them to do?
I think, and interestingly, we spent a lot of time Sunday night, talking with our portfolio managers, first trying to figure out what our view was. So, I think in light of the economic decline that we would expect if tariffs were in place that I referenced, I would say equity markets are going to trade off on that. We saw that yesterday on the initial reaction, then sort of markets worked its way back. But, I think if it ultimately leads to lower earnings per share growth, right? This year, our view on equities was not a lot of multiple expansion, probably none. So it was all going to be driven by earnings. Now, if you had tariffs imposed and you're going to see a 3 to 5% decline in S&P earnings, that's not an unreasonable expectation of how the market would pull back. And there you want to sort of pull back, wait, and then pick up, the pieces, if you will, because still long term, we think the growth environment is constructive.
Yeah. So, in other words, you think that this is still an expansion and a bull market that is underway and intact, and these are just going to be little
tricky couple of quarters, but long-term growth expectations better than we had going into the fourth quarter of last year.
So, a pretty decent starting point.